Hello, I'm Chris Pedersen, and this is Stock Watch on Thursday, the 22nd of August, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. A few of my market observations this week. First off, the ASX 200 on Tuesday closed at 7,997.70, just a touch below 8,000. Well, this is a full retracement of the early August drop. Earnings season is going well so far. Nothing to alert us about the dangers ahead. Do not waste time guessing when the RBA will cut rates. Instead, just keep investing and be patient. Major market performance in 2024 around the world. Well, what we see is that the S&P 500 is performed amazingly well. This shows various countries. It doesn't show Australia. We've performed just okay. Here's a chart showing emerging market performers. What's important here is that India and Taiwan are the best performers. As we know, follow the trend. Commodities since 1995. Well, this is the percent gain on various commodities. At the top of the chart is iron ore. It has been a stellar performer. Absolutely incredible. It's a super cycle. And this is iron ore showing how it's performed for the past 20-25 years. It has really been an amazing investment. Will it continue to be so? Well, we don't know, but it depends sort of on China because they're the biggest user of iron ore, turning it into steel. What drives home prices? Now this is out of the United States, but it equally applies to Australia. What we see on the left is price increases. What we see on the right is supply of homes available to be bought. Obviously, if there's less houses, prices go up. Australia can learn from this. Kamala Harris recently announced an initiative to build 3 million homes in the US, and everybody is saying that will get prices stabilized, maybe even slight declines. We can learn from that too. Why chocolate's expensive? Well, this chart tells you everything you need to know. The price of cocoa has soared. This is an interesting chart. It doesn't have much to do with business, but nonetheless, we all like our wine. This is countries in Europe and the number of wine regions. We would expect France to be at the very top. Well, surprise, it's Italy. Today's topic is ETFs. I'm going to do a deep dive, not as deep as I'd like to, but I don't have an hour or two. This was because a viewer requested me to look into a few. And I've been doing a lot of work on ETFs and asset allocation on a global basis and local basis. And to me, it seems the way to go for most investors. So here we go. We are in the middle of a reporting season right now, which can become overwhelming for all the new information and data updates. When you own ETFs, you don't have to do all that. They are broad-based indices in general. For many investors, I think Warren Buffett is spot on when he says, keep it simple. I believe in that. Keep it simple. I can't repeat it. If it's complicated, don't understand it, don't get involved. Learn before you jump. He says 90% you should put into the S&P 500 index, 10% into a bond fund. Now, his time horizon is not next year or the following year. He takes a 5, 10, 20, 30-year approach. Long term, the S&P 500 has proven to outperform almost all active managers, even fund managers who are called hedge funds, who are aggressive, turnover, use a lot of fancy strategies. Investing should be boring, and it should be like watching grass grow. To outperform almost all fund managers, you can do it easily using ETFs. First off, with an ETF, they're easy to monitor. You reinvest distributions. Now here's an example. If Trump took his inheritance and did this by investing in the S&P 500, he would be worth close to 10 times what he is today. For an Australian, I would modify it a little bit from what Buffett says and add the ASX 200. I have a model portfolio towards the end here. Some observations on ETFs. First, you have passive, which replicates an index, either broad or small, like a sector. Active is, there's a fundamental analysis model of various factors that they follow, such as earnings growth rate, dividends growth rates, things that I look at. Generally speaking, look to passive. Now remember that active managers underperform their benchmarks 75% of the time over a 5-year period. When we extend that to a 10-year period, even fewer outperform. Many reasons why, none of which will change this outcome. Passive ETFs generally have less management fees. The STW, which replicates the ASX 200, has a management fee of only 0.05%. Active ETFs typically have fees of 40 basis points or 0.40% or much more. Some are even as high as 1%, sometimes 1.1 or 1.2%. Can an investor predict which active ETF will outperform their benchmark ahead of time? Well, the answer is yes, but statistically speaking, only 25% of the time. So in practicality, 75% of the time you're going to be wrong. Then, will this outperformance be enough to offset the higher fees? Well, my view is good luck. Many broad-based ETFs have low fees, as I mentioned. They can be country funds such as ASX 200 or the S&P 500 or global funds or a regional fund or like Europe, Asia, whatever. Narrow-based indices are sector funds. An example is certain tech stocks, etc. There are cash management ETFs, there's bond ETFs, currency ETFs, gold ETFs, etc. You name it, you can find an ETF for it these days. Buy an ETF and keep it simple like Buffett or like what I do. The ones that I like and I have in the model portfolio here to show you is one that's an ASX 200 tracker, S&P 500 tracker, one that looks at global equities, a bond fund, a money market ETF for cash investments, maybe even a property ETF. The first one off the bat is I like the Spider ASX 200 ETF, which is on the ASX with the code of STW. Current price is around $72.14. Now the chart here is just replicating the ASX 200 index. It's been performing very well. Now, when it comes to these broad-based index funds, you have to remember that your time frame is not going to be 1 year or 2 years. You're looking at 3, 5, or 10 years or more, because short term, you can have a bear market or a recession. But we know from history that the market always recovers and goes to new highs. The ASX 200 STW index, well, some of the features are, as mentioned, broad-based index. It has annual fees of 0.05%, which is extremely low. Size is over 5 billion. And the ASX 200 is the benchmark for many institutional investors. Thus, when you own the STW, you will probably be performing better than 75% of active managers. The iShares S&P 500 Index ETF on the ASX has a code of IVV. It's trading around $55.41. Here I have a chart too. As you know, it's going to record highs because the S&P 500 is going to a record high, and this is almost an exact replication of that index. Some of its features are it has an annual fee of 0.04%, which is even lower than the STW. Size is over 8.5 billion, and the S&P 500, as you know, is the benchmark. Most U.S. institutional investors use that as their benchmark, so again, owning this means you're going to outperform 75% of the really smart active managers in the universe. The third one for a global exposure is the iShares Global 100. The code is IOO on the ASX and it's trading about $144 a share. The annual fees for this one is 0.40%, so it's not as cheap as the first two. However, it's still cheaper than most. The size is over 4 billion. Let me talk about size. The reality is the size can be much bigger than this, and it doesn't impact liquidity because the market makers, when you buy the ETF, they sell you the ETF and then they go buy the underlying securities, replicating the index. They turn it into iShares and they get new units, which covers what they sold. So it's an arbitrage for them, and the liquidity is as big as the underlying market itself. Now, by the way, this is good. I like it because it's cheaper than all the MSCI ETFs. The fourth one is a bond fund. This is the Van Eck Government and Corporate Bond Fund. It's called PLUS, the symbol PLUS, and it's trading around $16.90. What you see is that this has had a checkered past. When interest rates go up, this can, on a short-term basis, go down in price. That's because bond prices have an inverse relationship with interest rates. When interest rates go up, bond prices have to drop so that they maintain the yield that's current in the marketplace. What you see is that decline is when rates went up. Now rates have been going down a little bit, and you see that this fund is going up. You're owning this long-term. You're getting it for the yield and exposure to bonds. Bonds are good because they historically have a zero correlation to equities. However, to be honest, since the GFC, they've had a high correlation. But historically, when equities go up, bonds go down. When equities go down, bonds go up. But that is why asset allocators suggest you should own bonds, because of that negative correlation. Now, the features of this is it has an annual fee of 0.32%, and a size is, well, it's a little bit under 1 billion. That's okay also, because the bond market is very big and very deep. And as I mentioned, this is good if you think rates will be steady or decline. Right now, rates are declining, so this is a positive investment. Beta Shares Cash Plus Fund. This is a money market fund, basically. Instead of buying a term deposit, you buy this. You're going to get rates that are about what you get with term deposits, but you have instant liquidity because you can buy and sell this fund at any time. It has low fees of 0.18%. It's not big because a lot of people will buy term deposits, but it's good for parking cash short term until you know what you want to invest the cash in. As always, if you want to learn more about anything I covered today or about any ETF in general, send an email request to stockwatch@fnn.com.au and address it to me, Chris Pedersen. Hope you have a great, profitable week. Thank you for your time.